Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jared Stoutmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. Welcome back to the Active Turnkey podcast. I'm your host, Jared Stoutmeister, and this is the Tom Olson.
The Tom Olson.
Again, he's back with us today, and I appreciate you coming.
I'm here, Jared. I'm here for you, sir. I'm here for you.
For me. Today we have another exciting episode, and this one is kind of pretty basic. This is kind of like once I get into the idea of turnkeys, what's next? This is how to choose a turnkey market.
Yeah.
And so this is something that for me I hear all the time from investors. You know, what market should I be in? So
once you've done your financial freedom plan, you figured out like how you're going to do it, and you say to yourself, "Hey, rentals are going to be part of my strategy, right?" So, well, what do you got to do? You got to go out and find deals. So I think in order to figure out where you're going to find deals, the last thing I'm going to tell people to do is go out and just look all over the place and just look anywhere and anywhere. And you know, I've actually had people do that and come to me and find out that they've got like 30 properties all scattered all around it was probably 20 different property management companies and, you know, 20 different markets. And, you know, I think in the end, I do believe a little bit in diversification, but I think you ought to be diversified in a smaller basket, you know, like, you know, don't put all your eggs in one basket but maybe put like 5 really big eggs in one basket or something. Sure, I don't know, but figure out like how to have maybe a couple baskets, but the problem is it just takes more to manage. So, you know, I've even had a lot of our buyers that have, you know, sold a lot of other properties to kind of stay in our market because they really wanted to stick with one property manager. So there's a lot of the reasons why you want to pick a couple markets. If you're just starting out, if it was me and I was just starting out, and obviously you're going to hear a little bit, you know, in this, I'm obviously a little bit
is biased.
You know, I'm probably biased towards my market. So, you know, if that comes out in this episode, then I'll just want to be upfront with you. Like, I am biased about Northwest Indiana. I do believe that it has every little thing that you want to look for. You know, maybe we could be a little bit better on some items, but like it really does have what I think is all the boxes checked. But there's other markets around the country that I think have all the boxes checked as well. So to me, if I was brand new, or if let's just say I was in a different industry and I didn't do what I do, let's just say I was an engineer, or I was a big city planner, or I was a football player, or I was a baseball player or a basketball player, or you know, maybe I was a doctor or a dentist or, you know, an attorney, and I said, hey, I need to create a rental portfolio. I need somebody to build me a rental portfolio for me. I think about this in the terms of what I know now today of doing what I have done for the last 20 years, and what advice would I give myself if I was the other person, right? So that's kind of where this episode's going to go, about how to choose a market. So I'm excited.
Yeah, I like what you said too, because in speaking with investors, this is not just for new investors. Even though it seems logical in the order of things, you think, hey, as a new investor, where am I going to go? But you're exactly right. Last week I was talking to an investor. He's in 8 different markets, and he has 2 good property managers. 2. So that means he's in 6 markets where he doesn't really like his managing very much, but he doesn't really sound like he's slowing down. And it makes me wonder, why don't you sell what you got there, really focus in on those 2 or 3 markets that are really productive for you, that you have created some really good relationships, and go from there. So I think you're right on the spot, Tom. You nailed it.
Nailed it.
Should we? Are
we done? Should we just drop the mic now and stop?
There you go, folks.
Stop the podcast, Jared.
This is it's good stuff. So thanks. Yeah. So right off the bat, you're looking for a market, and again, there's so many different options. But what's off the bat one thing you're looking for?
You know, like I'm one of these weird people that I like stats. But thanks for agreeing with me, Jared.
I mean, you were doing so well.
You're like, yes, you are weird, Tom. But I actually enjoy stats or statistics. So I like, for me, and there was actually a report that came out from MSNBC that actually talked about all of the states from a rental income perspective, and they said which state out of all the states in the whole country has the best net returns on rentals. Guess what state that was?
Intercontinental?
No. Yes.
Okay. I'm going to say Indiana.
Yes.
Okay.
It was Indiana. And so it is literally like the best net return. So, by starting with that, that's great. But for me, when I'm looking at statistics and I'm trying to choose where do I want to go, I think for me, and this may not be easier for everybody else to think this way, but for me, I want to figure out where do I not want to go first. So, and the places I do not want to go are places that I know specifically are very hard on landlords for laws. And let's just face it. In today's society, we're very sue happy. We're very like. There are some states where they really side on the side of the tenant, and it's very unfortunate because I feel like there ought to be some middle ground. There ought to be some legislation, obviously, that does protect the tenant. I am all for having a fair shake, but like if somebody promises to pay and they don't pay, why do they get to stay in that place for 6 more months while you figure out how to get through the court system? And there are states in which are not landlord friendly. So I guess for me, I want to eliminate the places I don't want to go to first.
So with Indiana, with the country, how many states have you got right there?
For me, like I know for sure I would personally never invest in Illinois. Never.
That's interesting because we're about 20
exactly.
state line.
Illinois, probably never invest in California. When it comes to rentals, maybe I would buy a different type of property, and maybe there might be some different types of plays in these states. But if I know it's very landlord not friendly or very tenant like, they're going to lean towards those people, and unless you like dot all your, I know people in Cook County, Illinois, for instance, where the tenant took 9 months to get out. So they were trying to get them out for 9 months. They didn't pay rent for 9 months. Like, I don't want to be there. Right. I don't even want the chance of that happening. So I'm looking for states in which I know I can get a tenant out if they don't pay, if they don't do what they're supposed to do in a month or less. Like, you just don't want to have that. Like, that's, to me, that's the biggest cost factor over the long haul is vacancy and having people not in your property and turning over. Like, that's the biggest cost. So like, get rid of that. Like, try to get rid of the biggest possible. I always look at worst case scenario first, and as long as I'm okay with worst case scenario and I can handle worst case scenario, then for me it's a very easy yes. So like, I want to get rid of all those no's, the hard no's or the easy no's first, and then kind of really drill down into, well, let's go to the other end of the spectrum. Which states do I believe are the most landlord friendly? So so that's and again, like, I look at the whole picture as like, all these are weights. All these are like, if I had 20 different criterias, one may be a little bit more important than the other, but like, I'm just weighing all these. So if it's a really bad landlord friendly state, let's just say, but it looks like I'm going to be able to make a ton of cash flow, and then the appreciation is also going to be there, and we're at the bottom of the market cycle, and like, all these other marks are checked. Maybe I would invest for a rental in Cook County. But like, to me, like, I want to look at that first, and I really want to put that into the equation first. Is this a landlord friendly state or not? And then even within the state, is a landlord friendly county? Is the actual court system that these tenants are going to go to for eviction, is this a landlord friendly court system? So that's kind of like, to me, I look at that, and I'm not trying to just be the bad guy, but it just simply is what it is. You can offer cash for keys, you can do all the programs, you can beg tenants for money, but at the end of the day, like this, they are paying your mortgage. Like, so as an owner of a property, the tenant's paying the mortgage, and that's like, that's risk out there. That's debt that I got to pay on a property, and I want to make sure that I'm going to be able to pay that. And how am I going to pay that? By the tenant paying their rent. So I want to be able to get as much rent as I possibly can, right?
No, that's good. I mean, some people may be hearing that, they're thinking, hey, well, that means there's opportunity for me. And that's true.
Sure, absolutely.
There's plenty of opportunity in Chicago. There's a lot of people who are doing it. It's not impossible. It can be difficult. And if you're okay with those worst case scenarios, then go for it.
But on the flip side, I just had somebody today email me and tell me, I've been in the Chicagoland market. Like, he was an actual investor in Chicagoland, and he was one of the, actually, I had a conversation with him about 3 years ago, and me and him talked about this. And he's like, I am right now in the middle of liquidating all my Illinois properties and moving all my money to Northwest Indiana. And I'm like,
yeah.
I told you this 3 years ago. If you would have listened to me 3 years ago, you'd probably be a lot happy camper right now.
Well, the flip side to that would be there are some investors, I don't know how many times I've heard, yeah, I tried rentals. I don't do that anymore. You had a bad experience. Well, maybe you were just in a really bad place. Maybe it wasn't the place for you to invest in. And so you
or maybe you overpaid, or maybe you didn't have a good property manager, or maybe...
Yeah, among other things.
And honestly, like...
Could have been all of them.
I still think I don't want people getting into rentals unless they're going to get enough. If you're just going to buy 1 or 2 or 3 or 4, like, don't even buy them. It's not worth it. Like, it's not... But you have to be in this to go... You have to get a large enough statistical snapshot to be able to know what the ups and downs even feel like. So I really think 20 is a magic number, and I really want people to get to 10 as fast as they can, and then once they get to 10, get to 20. 10 will actually let you almost just about ride any kind of vacancy or any kind of thing that you have across all of your portfolio. But if you can get to 20, I think it really starts to make you start seeing how much more it makes sense and how the data kind of fits in year over year.
Okay, so you just mentioned landlord friendly states. The next thing we could talk about it, and we talked about this before the podcast, is you can be in what we could say one of those good markets or one of those landlord friendly states. And like the gentleman I mentioned before, who was in 8 markets, but he only has 2 good managers. I mean, look at the risk he's having there as far as how that's going. He could be in great spots. He could have had a great deal. So then what's next? What's the next issue you see running into?
It's about the relationships that you have there at the location. To me, I mean, and I'll always say, like, a good manager will outperform a bad market, and a good manager will outperform a bad deal. Over the long haul, like, you're gonna have bumps and bruises. It's going to happen. Like, you just don't know. Like, you might have the best, sweetest deal in the year in the world for 5 or 6 years, and then all of a sudden, like, something happens. I've been in properties where the same tenant's been in there for 25 years. Wow. I mean, where our offices, right now, we've got a guy who lives upstairs, and he's been there for 16 years. So, like, that happens, but I don't think I want to expect that to happen. That's not the norm. So I want to know that too, like, from the property manager, how long is your average person stay? Right. But I think the property management, your boots on the ground, where can you find reliable boots on the ground? And that's actually an issue. Later on the podcast, I think we're going to talk about, like, what markets do I recommend, like, right now. And I hate to pinpoint certain markets and be like, go here, because there's probably other great markets out there. I don't want to, like, discount all of the other great markets that are out there. I just know people, and I know people that are doing deals in these markets, and I know that is great markets. But some of the markets that I know of I can't find anybody that I think I would entrust my properties to. So I think it's a big deal. Like, where do you have trusted boots on the ground, where even if you might lose money a year, they're going to be honest with you, and you know that they're going to do it the best way they possibly can, and do it and manage the property the way you would want to manage the property. And do you have that long-term dialogue? Do you have the boots on the ground? Do they have everything in place? Do they have systems in place? Does the property manager know what they're doing? Do they have, you know what I mean? Like, can they evict people? How quick can they evict people? Like, do they have a software system? All these things I think are very important to understand. Are they going to communicate with you? Are they going to ask me questions? If I tell them don't reply to me at all, just send me bills, are they going to do that? And if I do that, are they going to be trusted to act as a good steward of my property? So, I mean, we talk about property management a lot on this podcast already, so I don't want to beat a dead horse, but, like, it is so vitally important, and I think you have to make sure that comes in. That's a big part of my mix. There's two places that I'm going to mention that I would buy in. But my hesitation to buy in those places is I don't know, and I don't know anybody else who knows, even though I have, like, many people who have invested in both of these markets. I know people who probably own at least 1,500 doors in each one of those 2 markets. And I'm not even going to tell you which 2 they are, but there's 2 markets out of, like, the 10 that we're going to market later. But I can't even find good property management. I can't even find people that I know that I believe, like, and trust, that I think would handle, everything the way I would want them to be handled.
So basically what you're telling me is you identify specific markets that are landlord friendly that
Mm-hmm.
would be really good fit for buying. It still doesn't mean you just get the green light. At that
I
point.
don't.
You're saying what you're saying is you would recommend somebody not just find that, but then go into that and get to meet some people and find out, hey, do I want to have a long-term relationship with this person?
Absolutely. Yep.
Cool.
And it has to be a long term. Like again, like this has nothing to do about this, I guess, but like about this podcast. But if you're not going to buy rentals for the long term, don't buy them. If it's not, I'm not saying that you get into this 3 and 5 years and you don't decide to change your mind and sell. But I think if you're in it for the rental, if you're in it as a rental, don't buy unless you're planning on holding these properties for 10 or 20 years. Now, again, if your plan is to buy and keep these for 3 or 5 years and then sell them, then I'm okay with not necessarily having some of these harsh stance, because you're really playing the market at that point and you're playing the game like a stock, like you are. And I've seen people make lots of money doing that. I've also seen people not make so much money doing that. So I'm okay with it either way. I just think everybody ought to go into it with their eyes open and not like have the wrong expectation. So, but I think for the most part, if you want a rental, you're trying to build wealth. You're trying to pass on a legacy of financial freedom to your kids. You're trying to create financial freedom probably for yourself, but you're trying to take advantage of every single wealth driver that's in a rental property.
Right.
And it's not just the cash flow. You know, like so many people get hung up on just the cash flow. And I'm like, yes, for 3 years you had great cash flow. Okay, for 1 year, maybe you didn't have such great cash flow. And then for all of a sudden now you're stuck with another turnover and you're like, okay, well, I'm going to lose half my cash flow for the whole year because of that one turnover. And I'm like, yes, maybe, but you know what? The whole big picture, like it's still really, really good. And you have depreciation, you have appreciation, you have a list, you know, tons of things that can go along with that.
Well, at that point, you almost have to realize that you ran all your numbers expecting the vacancies.
You should have,
So if you did do that and you built it in, then when the vacancy happens, one thing I'm finding with investors, like you're saying, you're finding the right market, it's in a good place, but they don't have the long-term plan. The first time anything negative happens, they're thinking, oh, this probably wasn't a good idea.
Right.
And that is not the good thing. You have to expect the problem, expect the issue, and realize
that's why it's put in the pro forma. That's why it's even
Right.
you should be planning on that. You know, so so the first thing I said is landlord friendly. Second thing I think we need to consider is property management. Like,
boots on the ground.
you know, what do you have for boots on the ground? Do you have a way out? Like, is there a realtor that you can even, you know, list the property with if you decide that you want to sell the property? You know,
Like wasn't a bad house in a good market.
Absolutely.
You know, you could just get a bad house.
So like boots on the ground, it's not just property management. I think it's all their boots on the ground as well. You know, making sure that the property management company might have all that in house, or making sure that you have other access to connections in that area.
Next thing, you mentioned cash flow curve. Explain that to me.
So for me, like I believe when it comes to rental specifically, there is a curve, and it's kind of like, you know, in some markets, $80,000 is kind of where this kind of curve kind of starts, and it's between where it makes sense and where it doesn't make sense. And I'm not saying a house over $80,000 doesn't make sense, but at some point in time, it stops making sense, in my opinion, to hold a rental as a traditional rental. So let me give you an example. In Long Beach, California, okay, like you can go to the bad area, the rough area, the C, D area, and you're going to pay $300,000 for a house. Well, how much can you rent that house for? Probably $1,800, right? So on that curve, where do you think that is probably not a no-go? That's you've gotten over that point where it no longer makes sense anymore. And I think this kind of goes back to the 1% rule that we talk about sometimes. So that 1% rule, so a $120,000 house that rents for $1,200, okay, it's still within that curve. It's still within those bounds. On the flip side, you know, you might look at properties sometimes where they're only $50,000, $60,000 or $30,000, and you might think, okay, well, it's renting for $600 or $700. That's 2 times number, and some people make great money in that. But in sometimes those markets are not so good. You know, for instance, like Gary, Indiana, I don't think would have been a good market 3 years ago. Like, I couldn't, in good conscience, tell people to buy in Gary, Indiana 3 or 4 years ago and pay $40,000, $50,000 for a property. even though it was renting for $600, $700, $800 a month. I feel like I can today because different things have changed. The market's changed. The people have changed a little bit. Our numbers are have changed, and the houses are renting faster, and so all those things have to kind of go into play when you vet your property manager and when you kind of know like what that particular market is. So I want to know like average days on market. When you put a house on for rent, how long does it take to rent? That's kind of market driven.
Sure.
It really is. It's a supply and demand issue.
Information.
Are people moving to that market or not? I think that is something to kind of consider. You know what? And to me, like I'm okay in a flat market. I'm not okay like if just people are just exiting. If it's just a mass exodus, that's a market that I'd be leery of. But I think when it comes to that, I want to know what's happening in in that market. So but back to the cash flow. So I like to me it kind of goes back to the 1% rule. I really prefer to stick around more like a 1.1 1.2% rule. And it has to make sense from a cash flow perspective because the cash flow is what holds this together. If you're not making any cash flow, if you're starting a deal and you're paying $200,000 for a rental that rents for $1,600, and at the end of the month, even though when you paid your taxes and insurance and property management and you have your vacancy and you have your whatever, if it shows like zero, I mean I know people in markets that buy for negative cash flow and they think it's a great deal. I just don't. Like I feel like, and again, the cash flow isn't meant, in my opinion, to be like that money I can always stick in my pocket every single month.
Right.
That money is to help sustain and help this whole thing work. It's what holds it all together. So that's what that curve means to me, and that curve changes because rents go up over time. $2,200 a month for rent was unheard of in most markets 5 or 6 years ago, but now it's very common. So like $180,000 would have never made sense for a rental property in that market several years ago, but today it does make sense. $2,200 for $1,800 a month rental, you might make $400 a month on that rental. So those are the things that I'm considering when I'm looking at a market. I personally probably prefer the affordable housing, the lower end, the sub $120,000 market, and I like that for many different reasons. And I think we might get into market cycles, a little bit at the end here, but so I'll hold off on that. But to me, like I'm looking for a market where I can get with when I'm plugging in vacancy and plugging in what do you call it? Maintenance. When I'm plugging in both of those, vacancy and maintenance, and I'm still coming up with $225, $250 a month in positive cash flow, to me, like those are good, solid, cash flow, steady markets.
So transitioning here, a lot of times when right away you start hearing markets, you hear market trends. You hear this all the time. And so we certainly think that's something you should evaluate. What direction are things going? How has it gone? But one thing you brought up to us earlier today in discussing this podcast was not necessarily the trend of where it was, but where is it going? Can you tell us a little bit more about where you're going there?
Yeah, so I want to know what's going on. So is anything happening? And I can even give you even though I do believe most of Northwest Indiana was a good market to invest in 3 or 4 years ago, there was really nothing big happening. There wasn't any big news. There wasn't any big corporations moving here. There wasn't anything that was like going to bring 1,000 jobs here. There was some small little things that just kind of steady would happen. But within the last year or so, like we've had announcement after announcement after announcement where it's 500 jobs here and 1,200 jobs here and another 500 jobs here, and Amazon brought 400 jobs, and like there's tech jobs, there's like hospital jobs, there's there's things happening that hasn't necessarily changed what the census data says in our market, but being in the market, I know what's going on, because I think what's going on in the market today is way more important than what like census data tells me has happened already. And a lot of times people don't identify themselves as moving or living in an area when they're kind of a transplant. And that's something that's been happening way more over the last 2 or 3 years than has happened previously. Is there's a lot of temporary transplant jobs. The problem is what happens when those temporary transplant jobs leave? Well, guess what? Those companies have to hire down full-time people to actually come and move and stay there and live. So companies have changed the way that they hire and changed the way that they move people around from one city to another city. And it's happening. That's something that I think everybody should pay attention to.
Sure.
So like I want to know what's happening in that market. So from like what's being built, what's being torn down, what roads are going in, what's the is there any infrastructure improvements that are happening? Like in Gary, Indiana, for instance, they're adding an extra track to the South Shore, the South Shore, which is going to go all the way past Michigan City and all the way out to South Bend, Mishawaka area. So basically, like you could live in South Bend and work in Chicago and be able to get there in like an hour and 15 minutes or something on the train. Like that's where we're going with this. So like that's what I want to know. Like I want to know what's going on in the market, and I think that kind of helps you understand what's going to happen in 3 or 5 years. Is this rental property still going to be a good, viable rental property in 3, 5, 10, 15, 20 years? And I think what's happening today in that market is a leading indicator of what that's going to look like.
I think it's really interesting you say that. And as you say that, Northwest Indiana, you're talking about jobs, and you're talking about they're not technically here yet per se, but they're building. They're getting to that point. And it's interesting. We have an odd situation in that our neighbor, Illinois, lost 40,000 people last year, and Indiana gained 30,000 people. So we actually have a more of like a funnel through Chicago, and it is changing the market. It's information, it's data that is really important. With us literally adjacent to Cook County, that is basically most of the population of the state, anyways, around the Chicagoland area. And so you would think about that's market information when you see that kind of exodus from a specific area. So that's actually pretty interesting when you talk about
and then for me, like I like stable markets when it comes to a rental like that. So you gotta be careful. Like yes, some people want these ups and downs so they can take advantage of the ups and downs, but like for the most part, most markets that I'm gonna invest in as a rental is gonna be a little bit boring. It's gonna kind of be like I don't really care about the property values as much as I want to make sure that there's steady increase in rent, steady increase in people, steady. I think in the long term, that's what wins the race.
Sure, that's really good. A couple more things we had talked about, and I think we have one more thing to get to before we get to our actual markets. So Tom's going to unveil his kind of impromptu list of markets.
You heard it here first?
Yeah.
Not really.
So just a few that he's recommending. But the last thing we want to talk about is the market cycle and what that means as far as in choosing a market.
So before I get to market cycle, I want to talk about like when I'm looking at a market outlook, I want to look at two different outlooks. I want to look at like the interim, like what's going on now, which is going to give me an indication of what's going to happen in 3 to 5 years. But then what is also the longer term outlook of this market? So what does this market really look like in 10 years? I want to think about that. So in 10 years from now, what are the odds of prices going up, rents going up? And honestly, like it's even one of the questions I ask my property managers. If I'm going to hire a property manager, a question that's on my list is how long do you plan on managing properties for? Because the last thing I want to do is I want to hire a property manager that's only going to be managing for 2 or 3 years. So I mean, one of my markets, I have a guy that I feel like I could hire, but like it's hard to think of it, because he doesn't think he's going to be managing in 5 years. So like asking your property managers or asking those people that are going to be that steward of your property. What's this going to look like for our relationship in 5 years? And if they're like on the way out, if they're like trying to like retire as a property manager, then I think that you have to consider that. So what is the short term outlook of this property and the property manager and everything else that we just talked about? And then what is the long term as well? What is this going to look like in 20 years? And think about it, like Jared, 30 years ago. So 30 years ago would have put us in like 1980s, right? So 80. 87, 89. So 30 years ago was 1989. Look at how much properties were worth 30 years ago, and then look at them today.
Sure.
I think this is what most of the short-term rental investors are not looking at. They are not looking at how much has this property gone up in 30 years, and then what's it going to do in the next 30 years. And I think this is why I'm so pro affordable housing and that lower bandwidth right now, because I really honestly believe in the next 20, 30 years, we may not see any houses under any single family houses, at least under $200,000. Like, it's very possible that you will not see that anywhere. So where's the best opportunity? If that does happen, if I am right, if it does happen, then where's the best opportunity? Well, it's not going to be in the $500,000 houses. It's not going to be in the $200,000 houses. Not even going to be in the $180,000 houses. It's going to be in that lower bandwidth. So, I mean, most of my personal rentals, I'm moving more towards that lower bandwidth myself right now. Like, I had rentals before that were, more in the 130, 140, 150 range. Now I'm moving everything down a level where I still like 80. I still like 120. I still like that good. I think it's solid. It's great. It's B class. It's working people. They're probably going to take care of the property a little bit better than like the $50,000, $60,000 houses. But really, like, I'm focused my portfolio, my mindset on that lower bandwidth, unless I'm doing something different, unless I'm doing a corporate rental, unless I'm doing a vacation rental, unless I'm doing something niche. I'm really focused on my single family rentals in that lower bandwidth right now. So, and then the reason why I'm doing that is I'm looking 3 to 5 years down the road. I think they're going to appreciate 50, maybe 100%. I really believe that. I know it sounds crazy, and I know, like, and I'm not promising that to anybody else. I'm just saying, like, that's why I'm investing in those markets, because I believe that. And then I'm looking 10, 20, 30 years down the road, and those $50,000 investments, if I'm right, and if even realtor.com came out with some of this information as well, that, like, if trends happen and they continue how they have for the last 30 years, we won't see houses under $200,000. So those same $50,000 houses 20, 30 years from now, there's a very good chance they're going to be worth 150, 180, 200, 220. And I like those numbers.
Well, does your strategy have something to do with inventory as well?
Well, it's always a supply and demand game.
Right.
It doesn't matter what it is, but especially in real estate. In real estate, it's supply and demand when it comes to buying and house prices. It's also supply and demand in rents. Why do rents go up? Because there's not enough supply and there's too much demand. Why am I investing more and more into Gary, Indiana right now? Because the demand is there. The demand wasn't there 3 years ago. It's there today. And I'm looking, and most people don't even know it's there yet.
Right.
I mean, even the local investors that I talk to, they don't even know because they're not in it quite enough. So then into your last question, market cycles. I think another part of the equation of where I invest in is where are we at in the market cycle? And I want everybody to know we do not have a national real estate cycle anymore. It's gone. It's no more. I don't believe that it exists anymore. We are so far out of whack. There's houses that look like Gary, Indiana, that are in certain areas of the country that sell for $1.2 million. It's insane. So there's this massive disparity in different markets. There are counties, or not even counties, like zip codes next to zip codes, and this zip code, for instance, has gone, like, is 150% of what it was in 2006, and this zip code is 50% of what it was in 2006. And so we have this very widespread, very localized economy now. And when it comes to the rental market, it's even more true. So I think that there are people out there that believe that we are so inflated and we're way over. And I think a lot of times those people come from certain cities. Sure. And you know where I hear this the most at? I hear this the most in Dallas, Texas. Sure. So if you're from Dallas, Texas, don't get on my bad side. Don't think I hate you. I love people from Dallas, Texas. I love Dallas.
You got a lot of friends down there.
I really do. I have a ton of friends in Dallas, Texas. But the problem is everybody thinks that the market's coming to an end and it's going to explode. And I'm like, guys, it's like, Dallas, Texas was a great stable market. There wasn't a lot of new jobs. There wasn't a lot of new things happening for 50 years. It was very stable. People made millions of dollars as real estate investors in Dallas for 50, 60, 70 years. And it just so happens that between Dallas and Atlanta are probably the two hottest markets in the country of people moving to. So what does that do? It changes the whole economy. And you're just Dallas, Texas, from an outsider's perspective and looking at this through the whole country, looking at Dallas, it is a good market. And I still think that it's a market that I would consider investing in. I think it's gotten a little bit out of that curve for the most part. So like what I was saying, like, if you're going to buy a single family house, you're going to probably pay like, $200,000. You're going to be into it for $200,000. It's going to rent for $1,800. So maybe it doesn't make sense anymore. There are probably some areas of Dallas and they're probably the rougher areas that might make sense for me right now. And even though like 5 years ago I wouldn't have invested in those rougher areas, I think today it makes sense because we haven't built. For the last 10 years, we have not built enough properties around the United States. And going into 10 years of not building enough, now what is everybody building? Everybody's building multifamily. So the multifamily market, in my opinion, is going to be saturated in the next 3 to 5 years with way too much inventory. And then we're going to kind of have a little bit of a weird, I think, cycle happen within multifamily. But right now, single family is not being built enough because nobody's building houses under $300,000. It's like almost non-existent.
Sure.
So, knowing what part of the cycle you're in, but knowing what part of the cycle a specific market is in, I think is key. So I'm looking for markets that haven't gone past, that are still way below, where numbers were in 2006. So like in Gary, Indiana, for instance, houses were appraising 60, 70, 80, 90 grand. Like that was the typical average between 60 and 80. And right now they're still like not there in most markets, in most areas. Jackson, Mississippi is another great example. $80,000, $90,000 was average in South Jackson. Now, like you could still buy houses for 40, 50 grand. So like to me, like I think that indicates, it shows me like there are markets right next to each other that are not there yet. I really like secondary markets over primary markets, period. So like I'm not a big Los Angeles guy. I'm not a big Tampa guy. I'm not a big Miami guy. I'm not a big if it's a number one, if it's a big market, Chicago, LA, New York, like that's not me. I'm sure there are people that make a lot of money in those markets. For me, that's just not me. And if I'm going to invest in another market outside of my market, if I'm going to invest in New York City, I'm probably going to be in New York City. Like to me, like it takes a whole different level of focus and like on the ground yourself, making sure everything is perfect in order to make money in a market like New York City or Chicago or LA or Miami or Dallas or Houston or those big markets. I think you have to be there. You can't invest, if from an outsider. But the secondary markets, I believe, are a lot softer, a lot more forgiving. Harrisburg, Pennsylvania, for instance, I think is a great market, but nobody knows about it.
Sure.
It's those markets that like they're steady, they're not going anywhere. They have good people that live there. That South Bend, Indiana. I think South Bend, Indiana is awesome for long term. There's a lot of different small markets in Indiana that I think people ought to consider. Sure. Even Bloomington, Indiana, Greenwood, Indiana. You could even go down to Columbus, Indiana. You could go over. There's lots of these little small markets in Indiana. Obviously, like I've said, I am biased towards Northwest Indiana or any other market, really. So if there's any other market that's outside of a big market. Sure. That has transportation that goes through, that's close enough where you can drive to those big markets. For instance, Atlanta. Right now, Atlanta has a bunch of sub-markets outside of Atlanta that are really good for long-term rentals. I think Dallas still has some around there. I think that there's areas all around the country, though, that are like those areas. Like I already mentioned Jackson, Mississippi, so we've kind of getting into the actual markets. Is there any markets that I mentioned to you before? Maybe Birmingham, Alabama is a area that I might be interested in.
Well, I have a short list, and there's more that you mentioned that we can hit. But before we hit the list, because I think that's what everyone really wants to hear is that list. But if you could listen, it sounds to me like you want to find a place that's landlord friendly, all those different things, but you really gotta know that market. You gotta really learn, and it seems from even our perspective, a lot of people, they get it. They get the idea that they need to build passive income. They get that turnkey is the way to go, and then from there, it's like as soon as they make the decision that I've waited too long, I need to invest, they just start going. They just start buying, and then if you're not careful, you're in those 8 markets, and you might have 2 good managers. So it sounds to me, from what you're describing, you correct me if I'm wrong, because normally you would do that, would be that do your homework and don't listen to everybody in the market. Because Tom's going to give you different markets. It's really interesting. We're going to give you markets you can invest in, and that's people who do what we do. But a lot of times, people who are telling you about their market and their market only, of course, they're going to promote their own market. So it just seems to me like we need to be very careful in who you're listening to, what they're saying, because sometimes a new market pops up that's just all of a sudden it's a great market, And
Yep. I mean, I didn't tell you this before, but like even like around Fort Myers, I think Florida is like booming right now. Like it really is a place where people are going. Do I want to live there 24/7, 365 days? No, it's too hot for me. But but I would love to live there for 3 months out of the year.
I think it would take that.
I think it'd be great for 3 months out of the year.
We'll talk to you in January,
Yeah.
February.
So January, March, and April, maybe May, like January, February, March. I think 3 months out of the year, I'd love to live in Florida. But anyways, like that. Those are the things that I'm looking at. Another market that I haven't mentioned that I really do like is San Antonio, even though it's really hot down there, and it stays hot all year round, and it's 100 degrees like a long time. I do like San Antonio, San Antonio is not like a Houston. It's big,
Sure,
but it's not like a Houston. It's not like a Dallas. I even like Houston. I think Houston has some really good benefits. Personally, if you said, "Hey, where would you invest, Houston or San Antonio?" I'd probably pick San Antonio. But I think it's because it's more insulated. Like there's a lot of things that don't happen there. As far as an area as well, something we didn't mention, and maybe I just mention it quickly, is I prefer a diverse economy.
sure.
So what I don't want is I don't want to invest in something in an area whether that is strictly one. Oil and gas, all agriculture, all casino, all hospital, all like I don't care what it is. At any given time, we could make legislation. A hurricane could come. I mean, anything could come in, and anything could change that overnight. And I think I like to see a small percentage of a lot of different sectors in a market, and I don't think I really mentioned that, but I do like a diverse economy as well. So I think I've given most of my list then, Jared. Pittsburgh. Pittsburgh.
So here's some other ones, and we'll go from an order for number one. Do you remember what your number one market was?
Northwest Indiana.
Okay, so that's number one. Okay, all right. You had Jackson, Mississippi.
Yep, I love Jackson, Mississippi.
There you had South Bend.
Yep, I love South Bend.
Kansas City.
Oh, I forgot about. I love Kansas City.
Right.
Kansas City, I think, has had a lot of, and actually, it's both sides. So Kansas City, which I didn't even realize this until recently, but the last 3 years. But Kansas City is in two different states. So you have Kansas City, Missouri, and Kansas City, Kansas. Yes. So so those are great markets as well. There's also an area. This is kind of weird because it's outside of Branson, Missouri, but it's actually in like northeast or northwest Arkansas, and that's actually a good market as well. Like I've heard really good stories about that area as well. There is, like I said, there's too many to list, but I know there's a lot of good markets around the country.
We'll just hit this list quickly and then we'll wrap things up.
Okay, wrap it up.
Northwest Indiana, you had Jackson, Mississippi, you had South Bend, Kansas City, the burbs are around Atlanta. You had Pittsburgh, Harrisburg, Lancaster area, Louisville. You mentioned Louisville.
I like Louisville too.
And that was just a few of them on top of others. And so definitely hope you had some value today from this podcast. And Tom's trying to be as open and honest about different markets that you could be in.
Did we mention Indianapolis? I do like Indianapolis, although it's not my favorite Indiana market from a rental perspective. I do like Indianapolis. I think it does have growth, and it's going to sustain, and it is a diverse economy. So that I do like Indianapolis as well.
Well, don't forget, we do build rental portfolios for investors. So if you're interested in doing that, you can reach out to me. You can reach me at jared@buyolsongroup.com or go to our website right up there, buyolsongroup.com. So thanks again for joining us on this podcast at the Turnkey.
The best way to buy rentals.
Thanks, guys. Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast or the compliance with the applicable laws of such materials and/or links referenced herein.